Over the past few weeks, Bitcoin has faced significant selling pressure despite strong long-term adoption trends. Many investors are asking an important question. If institutional adoption continues to grow and Bitcoin remains one of the most discussed assets globally, why has price performance remained under pressure? One macro analyst who recently shared his perspective is Luke Gromen, founder of Forest for the Trees. Gromen revealed that he sold a large portion of his Bitcoin position near recent highs and has only made limited purchases during the recent decline. His reasoning wasn't based on Bitcoin technology, regulation, or adoption. Instead, his focus was on liquidity, the flow of money throughout financial markets. Today, we'll examine his thesis, understand how liquidity affects Bitcoin, and discuss several scenarios that could influence Bitcoin's next major move. What is liquidity and why does it matter? When discussing financial markets, liquidity refers to the availability of capital-seeking investment opportunities. Assets such as stocks, commodities, real estate, and cryptocurrencies all compete for this capital. When liquidity is abundant, investors generally become more comfortable allocating funds toward risk assets. When liquidity becomes concentrated in a specific area of the market, other assets can experience reduced demand, even if their long-term fundamentals remain unchanged. According to Gromen, this may be exactly what is happening today. How AI stocks may be impacting Bitcoin. One of the strongest themes in global markets over the past few years has been artificial intelligence. Investors have directed enormous amounts of capital toward companies involved in AI infrastructure, semiconductor manufacturing, cloud computing, and data centers. As a result, a significant portion of market liquidity has become concentrated within a relatively small group of technology companies. Gromen argues that this concentration may be limiting the amount of capital available for alternative investments such as Bitcoin. This does not necessarily mean Bitcoin's fundamentals have weakened. Instead, it suggests that investors are currently prioritizing opportunities they perceive to offer higher short-term returns. The role of energy prices. Another factor highlighted by Gromen is the impact of rising energy prices. Higher oil prices affect transportation, manufacturing, logistics, and overall business costs. When energy expenses rise, they can reduce available liquidity throughout the broader economy. Historically, periods of increasing energy costs have often coincided with tighter financial conditions. From Gromen's perspective, both the AI investment cycle and elevated energy prices are contributing to a more challenging liquidity environment for Bitcoin. Bitcoin as a liquidity indicator. One of the more interesting aspects that Bitcoin can serve as an indicator of overall market liquidity. While major stock indices may appear strong, those gains are often concentrated among a limited number of companies. Bitcoin sometimes reacts earlier to changing liquidity conditions than traditional markets. This is why some macro investors monitor Bitcoin not only as an investment, but also as a signal of broader financial trends. The long-term outlook. Despite his near-term caution, Gromen remains constructive on Bitcoin over longer time horizons. His view is based on the continued expansion of government debt, monetary policy trends, and the gradual decline in purchasing power experienced by fiat currencies over time. In this framework, assets with limited supply, such as Bitcoin and gold, may continue to attract capital over the coming years. Therefore, his short-term caution should not be confused with a long-term bearish outlook. Possible future scenarios. Scenario 1. Improve liquidity. If central banks ease financial conditions, interest rates decline, and liquidity expands, Bitcoin could benefit from renewed capital inflows. Scenario 2. Continued liquidity tightening. If liquidity remains constrained and investors continue concentrating capital in AI-related sectors, Bitcoin could remain under pressure for an extended period. Scenario 3. Capital rotation. A slowdown in AI-related growth expectations could encourage investors to diversify into alternative assets, potentially benefiting Bitcoin and the broader cryptocurrency market. The key takeaway is that Bitcoin's recent performance may be influenced by factors extending far beyond the cryptocurrency market itself. According to Luke Gromen's thesis, liquidity remains the primary variable to watch. Whether capital continues flowing into AI, shifts toward alternative assets, or expands across the entire financial system could play an important role in determining Bitcoin's next major trend. As always, understanding liquidity may be just as important as understanding Bitcoin itself. Markets move on information, but successful investors focus on understanding the bigger picture. If you want more in-depth analysis on Bitcoin, crypto, liquidity, and global macro trends, subscribe to Stickverse Crypto and stay ahead of the market. Thanks for watching.